Something is moving inside the silver market right now, and most people scrolling past their phones have absolutely no idea. In just 14 trading days, silver ripped through levels that analysts told us were impossible this decade. Gold, the metal everyone watches, is sitting still, but silver? Silver is sprinting. And when these two metals stop dancing together, history says something big is about to break. Central banks that haven't touched silver in 100 years are suddenly stacking it. Asian vaults are pulling in tonnage at numbers that haven't been recorded since before the iPhone existed. American warehouses are draining. Premiums in Shanghai have exploded into double digits, and a brand new Federal Reserve chair just walked into a $40 trillion debt trap with no exit door. This isn't a rally, this is a repricing. You're watching FinShift with OG John AG Official, and over the next few minutes, I'm going to walk you through exactly what's happening, why it matters, and what the smartest money in the world is quietly doing about it, before the rest of the market catches on. Hit that subscribe button, drop your city in the comments so I know where in the world you're tuning in from, and let's get into it. Let's start with the numbers because numbers don't argue and they don't have opinions. At the end of April, silver was sitting quietly around the $71 zone. Boring, sideways. Most retail investors had written it off, the forums were dead, the YouTube videos weren't getting views, the metal had become invisible. Then, almost without warning, the chart cracked open. Within 10 days, silver was trading above 73. A week later, it pushed past 80, and by the middle of May, it was printing prices in the mid-80s. A move of nearly $14 in a window so tight, it caught even seasoned traders off guard. Now you might see today's pullback and assume the party is over. Don't. Sharp pullbacks inside structural moves are not the ending. They're the breathing. Every major commodity bull run in history has been built on these stair-step corrections. The buyers stepping in underneath this market are not the same buyers who showed up in 2020. These are deeper pockets, quieter pockets, and they're not flipping. They're accumulating. Here's the detail almost nobody is talking about, and it's the most important clue on the entire board. For as long as most of us have been watching markets, silver has been gold's little brother. Gold leads, silver follows. Gold rallies, silver rallies harder. Gold drops, silver drops twice as fast. That was the rule. That was the relationship. That relationship just broke. Over the last several sessions, we've watched gold trade flat, sometimes even slightly red, while silver climbed $2 or $3 in the same window. That divergence is not random. That divergence is a fingerprint. It's the fingerprint of structural demand showing up in one metal but not the other. Why? Because gold and silver, despite sharing the same shelf in your local coin shop, are two completely different animals right now. Gold supply is tight but stable. Silver supply is in an actual measurable documented deficit. And the moment a paper market can't hide a physical deficit anymore, that's the moment the price starts telling the truth. Silver isn't trading as gold's shadow anymore. Silver is trading on its own gravity now, and that gravity is pulling in one direction. Now let's travel east, because that's where the real story lives. While Western traders are staring at red candles and panicking on Twitter, something extraordinary is happening on the Shanghai Gold Exchange. Physical silver prices there have touched levels near $100 an ounce. Not a forecast, not a projection. An actual transaction settling on the largest physical metals exchange in Asia. Now compare that to what you're paying in New York. The US spot price has been hovering in the low 80s during the same window. That gap, somewhere between $14 and $16 per ounce, translates to a premium north of 16%. 16%. Think about what that means. Chinese buyers are willing to pay a 16% surcharge over the Western paper price just to get their hands on real metal. When premiums of that size appear in any commodity market, it's never an accident. It's a signal that the official price and the real world price have started to disconnect. And there's an even deeper layer underneath this. The Shanghai futures market is currently in something called backwardation, a fancy word that simply means buyers are paying more for silver today than for silver delivered later. In every commodity textbook ever written, backwardation means one thing: a physical shortage is here, and it's here now. Let's zoom out to the country-level data, because this is where the story stops being a chart and starts being a strategy. In a single recent month, China imported roughly 836 tons of silver. To translate that into something your brain can hold, that's around 27 million ounces of physical metal pulled in within 30 days. That figure is the highest monthly silver import number China has recorded in 17 years of available data. Not a high, not a peak, the highest ever recorded. So the obvious question becomes, where is all of it going? The answer is uncomfortable for Western analysts, because the metal isn't being flipped, traded, or recycled into ETFs. It's being absorbed into industrial supply chains, into solar panel production, into electronics, into state reserves, into hands that have no intention of ever selling it back. And this is what accumulation looks like when a superpower decides a metal matters. It doesn't announce itself with a press conference. It shows up quietly, month after month, in customs data nobody is reading. Until one day, everyone realizes the vaults in the West are empty and the vaults in the East are full. For the first time in modern history, Russia has officially added silver to its national reserve plan. Read that line again because it's bigger than it sounds. Russia, a country that has historically built its monetary strength on gold, oil, and foreign currency, has just opened a brand new chapter. In late 2024, the Russian government formally announced that silver would be included in its state reserve fund, a sovereign-level commitment to accumulate the metal. Since that announcement, silver has quietly outperformed gold on a percentage basis. That's not coincidence, that's footprints. When a central bank buys silver, it doesn't pick up a few coins. It moves in tons, it moves consistently, and once that metal goes into a sovereign vault, it's gone, out of circulation, permanently. And the rumor mill suggests Russia isn't alone. Whispers from the Middle East suggest at least one or two sovereign wealth funds in the Gulf region have begun building silver positions of their own. Officially, none of it is confirmed. Unofficially, the demand pattern showing up in the data only makes sense if large state-level buyers are already active. Add it all up, China at historic volumes, Russia at the sovereign level, the Gulf rumored, and India absorbing through tradition and culture, and you've got four major demand engines firing into the same shrinking pool of metal. While the East has been accumulating, the West has been bleeding. Silver inventories sitting in U.S. COMEX vaults have fallen back to pre-tariff levels. That metal didn't evaporate, it didn't disappear, it moved east quietly, container by container, shipment by shipment. This is the part of the story major financial networks don't want to lead with because it changes the entire pricing narrative. The silver market is no longer being driven by speculation desks in Manhattan or Mayfair. It's being driven by physical demand in Shanghai, Mumbai, and Moscow. That is a tectonic shift in how this metal gets priced. For months, silver ETFs in the West were bleeding investors. Holdings were shrinking, the narrative was negative, sentiment was dead, then the flows reversed. The most recent data shows 3 back-to-back sessions of net additions into Western silver ETFs. The selling pressure has broken. And here's the part most people miss. Silver doesn't need a flood of new buyers to keep rising. It just needs the existing holders to stop selling. The move from heavy outflows to neutral is, on its own, a massive bullish shift. The room for Western investors to come back is enormous, and they've just started walking through the door. Let's talk technicals, because if you're holding silver or thinking about buying, this is where it gets practical. Silver has run from the low 70s into the mid 80s in roughly 2 weeks. That's a vertical move. Vertical moves always meet resistance. The next major resistance band sits somewhere between $88 and $90 per ounce. The first time silver knocks on that door, expect profit taking, expect a fade. Expect the headlines to scream that the rally is over. It won't be. The second test is the one that matters. If silver pushes cleanly through 90 with conviction and volume, the next measured move, based on classical chart structure, opens the door to triple-digit territory, with technical targets stretching well past $115 per ounce. And the longer-term technical picture, some of the most respected chartists in the precious metals world are openly discussing price targets that, a year ago, would have sounded insane. 300, 500. Are those next quarter forecasts? No. But are they on the long-term map? Absolutely. The destination, in the words of more than one veteran analyst, is not really in question anymore. Only the timing is. Now let's lift our eyes from the silver chart and look at the macro picture, because this is the foundation underneath everything we've discussed. Recent inflation data came in hotter than expected. Consumer prices climbed faster than forecast. Producer prices, the wholesale level numbers, did the same. And here's the truth most retail investors keep missing. Inflation is not a temporary visitor. Inflation is the dominant macro force shaping the precious metals market for the next decade. Everything else, rate decisions, Fed press conferences, political headlines, is noise built on top of that one variable. And the Federal Reserve just got a new captain. Kevin Walsh has been confirmed as the next chair of the Federal Reserve. The political pressure to bring rates lower is loud, public, and ongoing. Walsh himself has been openly critical of the previous monetary regime, even using the phrase regime change in past interviews, a phrase that carries serious weight in central banking circles. The market is pricing a high probability that rates stay unchanged in the next meeting. But here's the kicker: gold and silver have been climbing anyway. That single fact tells you the era when the Fed could control precious metal prices through interest rate moves is quietly ending. Here's why the Federal Reserve is structurally trapped, and why that trap is the single biggest tailwind for silver. Back in 1980, Paul Volcker famously crushed inflation by raising rates to 15%. He could do that because the U.S. national debt at the time was around $1 trillion. The math worked. Today, the U.S. national debt is closing in on $40 trillion. Run the math at 15% on $40 trillion, and the annual interest expense alone climbs into the $6 trillion zone. That's not sustainable. That's not even theoretically possible. The tool Volcker used to save the dollar has been physically removed from the toolbox, which means real interest rates, the gap between official rates and actual inflation, will keep widening. And every time that gap widens, hard assets like silver become more attractive, not less. Layer on top of that the geopolitical tension still bubbling across multiple continents, the fiscal stress inside major economies, and the fundamental supply deficit inside silver itself, and you don't get a trade. You get a regime change in how the world prices money. State legislatures are already moving. Alaska has now passed legislation recognizing gold and silver as legal tender, joining a growing list that includes Texas, Florida, Kansas, and others. The constitutional restoration of metals as money is happening quietly, state by state, while most of the country is distracted. So let's bring it all home. Silver's recent surge isn't a fluke. It isn't a meme. It isn't a short squeeze that's going to fade by next month. It is the visible surface of a much deeper realignment, a shift in how the global monetary system prices real, physical, scarce assets. The East is accumulating, the West is waking up. The vaults are draining, the premiums are rising, the deficit is real. The central banks are buying, the state legislatures are moving, and the Federal Reserve, for the first time in 40 years, has no good tools left to fight what's coming. If you've been waiting for a moment to pay attention to silver, this is the moment. Not because anybody can promise you the next price tick, nobody can, but because the structural forces driving this metal are no longer hiding. They're in the data. They're in the imports. They're in the inventories. They're in the chart. The smart money has already positioned itself. The real question is whether everyday investors recognize what's happening before the next leg up makes today's prices look like a bargain. This has been FinShift with OG John AG Official. If this analysis added value to your day, smash that like button, subscribe if you haven't yet, and drop a comment below telling me where in the world you're watching from. Your city, your country? Let's see how far this conversation has traveled. Until next time, stay sharp, stay positioned, and stay one shift ahead.